So we've hit 4:15. So I'll start kind of the official thing. Please feel to interrupt, and as people come in and out, they can ask questions as needed. Super informal. The biggest thing that we're seeing in the market is the shift on tariff policy. So the pause with the China tariffs and the deal with the UK tariffs have been the big drivers of what's moved us higher. So if we look at what's going on, and this will be the S&P 500, this is one of those ones that the market, if we look back in 2018, this is this peak here. This is the base of COVID. And we've operated kind of in a channel moving higher. And what everybody's trying to figure out is, as we zoom in and go closer, is this was the post-election high. This was the post-tariff low. And the question now is, in bouncing around this kind of center area on the line, we've definitely moved higher, is whether or not the tariffs are going to stick long-term or not. And in all the things that we're looking at is, the longer the tariffs last, the more, I guess, of the buffer that some of these companies have kind of drifts away. So we've seen different companies react in different ways. Those who have inventory, the larger companies, they are able to hang on to this with the thought process of burning down inventories, not having to raise prices, and waiting to see how much of the tariffs are negotiating tactics and how much is a long-term increase to their costs. And we're starting to see the prices getting passed on. I know that, when I was talking with my wife earlier today, we were looking at doing a Walmart pickup order, and all the prices seemed significantly higher than they were the last time around. So you are starting to see it. The big question will be is how long they stay on. We're definitely in that area of the world of thinking, okay, if it's just negotiating, fine. If they drop down to the 10% across the board, probably okay. But definitely, a headwind for everybody. And then if we can get some of them to fall off completely, we'll see where we're going. You're already seeing companies start to react. You've already had things like Apple announcing, what they wanted to do with moving manufacturing to India. Whether or not that gets, shifted. I know the president wasn't real happy that it was going to India as opposed to America, but those are the type of things that you're going to start seeing happening. Where I start to get worried and where it becomes more than just a issue of, is that stock, is that company going to make as much money as they potentially would have, is if the consumer stops buying. And then ultimately, because of the prices being higher, the consumer stops buying, companies lay people off, and then you have kind of that traditional recession. And we haven't had a traditional, employment-driven recession because of lack of demand in a while. We've gone through, the COVID recession. We had the Great Recession based off of subprime and where that goes to. We had the dot-com bubble. We've had oil prices that have caused it. But we haven't just had that pure, prices got out of control. People stopped buying, which led to that spiral. So that's where we're keeping our eye right now. The employment market still seems pretty good. The Federal Reserve still has the ability to cut rates if they want to. So we're not, and that's kind of what you're seeing in the market as well. This bounce back has been on the thought process that these deals can get worked out maybe by the end of the summer. Maybe they start working on some of the stuff within the tax extension on the Tax Act in whatever form it is, whatever, the House is able to get through. I think they're planning on the vote on Thursday. Will be dramatically changed by what happens in the Senate. So until we see what's in the actual bill, that's kind of hard to tell. But right now, I still think we're in a good place and in a place where we can be comfortable that our allocations are okay, but very cautious of the idea of whether or not we're kind of going into a recession. If these tariffs last too long, you could go back to Smoot-Hawley with the Great Depression when tariffs lasted way too long and caused that type of thought. But I don't think we're anywhere close to that yet. The tax cuts and tariffs out, taking those off the equation, most businesses are still pretty strong, especially the large cap. The small companies of the world, the small businesses just that aren't on the exchange, they're all struggling. And so we'll see how long that impact can last before we start to see it out into the economy. We're going to pause there, and then I'll hit the topic for today and see if anybody's got any questions. So what I wanted to share today a little bit is just a real brief review of whether or not a Roth conversion makes sense for people. And we're starting to talk to a lot of people about this. And the idea being that, especially in uncertainty with the tax environment, especially if we think taxes are going higher over the course of the next decade, to pay off the debt that we're accumulating, which that's about the only way that you could functionally pay. We hope that we have GDP growth that's large enough to pay down our debt, but we haven't done that in a while. So ultimately, got to pay it somewhere, and if that comes through taxes, it comes through taxes. So what is a Roth conversion? There's a lot that goes into these things, and I'm going to oversimplify it. But basically, we're taking the money that's in a traditional IRA and moving it to a Roth IRA. So the traditional IRA, you got the tax benefit when the money went in. So whether that was withheld from your paycheck at work and it went into a 401k or a simple plan or whatever retirement account that you have, and then it rolled into a regular IRA, you get that tax benefit up front. The Roth IRA, you don't get any tax benefit up front, so it's not withheld from your income, but you get the same benefit that the traditional IRA does, that it grows tax-free for the entire time it's in there. Where the Roth then starts to be more beneficial, and it's the best account that you can basically have in the investment world, is that the money comes out tax-free. When money comes out of your traditional IRA, because they didn't tax it on the front end, pay income tax then, the Roth, because it's already been taxed, comes out tax-free. There's some other benefits in that you don't have required minimum distributions in retirement with a Roth. You can be strategic with it. Money that goes into a Roth, you can pull back out the contribution within that first 5 years without penalty. There's some on growth, you've got some tax rules, but a Roth conversion, once you get past the logistics of it, is really a beneficial tool in your overall financial planning. So why we would do it would be, if we're expecting higher tax rates later, which we're just talking about with, income tax brackets potentially going up. That's one reason we would do the reducing the RMDs in the future. And I'm going to run through an example showing the math on how that works. If you have a low income year, so especially in periods of time, maybe in between jobs or right after retirement, before you start taking other distributions, that's a good time to do it. Prepaying tax for heirs. So that's going to be a huge one. I'll just briefly kind of mention it here and talk about more later. It's the idea that if someone inherits a Roth, the money that comes out of it is tax-free. If you inherit a regular IRA, the money when it comes to you is still taxed. So it could come to you at the worst possible time from an income standpoint. And so if we're looking through this, and I'm going to shoot through some of these slides because I thought they were shifting. They were shifting on the other screen apparently. one way to think about this math is we're trading today's tax for long-term growth. So yeah, we're paying a little bit up front, but long-term you break even. Break even, it's completely dependent upon your scenario, but the average is 5 to 10 years. It could be a lot sooner. It could be a little bit later. They have a lot of things to consider, whether or not you use the funds in the IRA to pay the taxes, or if you use outside funds. And you just got to look at a lot of the brackets. But the big part of that is you're trading today's tax. Yeah, we have to pay it up front, but the long-term benefits are really good. Common pitfalls. If you convert too much too fast, it can trigger a lot of things. So one of the things that we run into a lot of times is, especially for people who are in Medicare, you have income limits on how much income you have. So if we go over those brackets, we can all of a sudden be paying, double for our Medicare costs. We could potentially, if we're already making money or have a big capital gain, this can exacerbate that, and we end up paying more taxes than we should. So it's always a good thing to run through the scenarios and see all the possible other places that we get income. But outside of that, then it becomes much more, easy to identify the right time to do it. So when is then the right time to do it? Typically between ages 60 and 72, that's a low income window for a lot of people. When we can pay the taxes with outside money, that makes it even better. So, it's not a bad thing. If let's say we wanted to move $10,000 from a traditional IRA to a Roth IRA, and we're in the 20% bracket, we have to pay $2,000. If I can pay that $2,000 out of my checking account and allow the $10,000 to continue to grow in its entirety, that's makes it even easier. When we've already planned out our QCDs, or qualified charitable deductions for charity, so when we know how those are going to be handled, we can kind of isolate that in the traditional IRA and move the rest to the Roth. And those are places that I think, very typically, depending upon a situation, we want to start at least having the conversation. So a lot of times right after tax season, we're seeing this a lot. And saying, okay, based upon this tax return levels, we'll go one way or the other. This is a big reason too that I'm pushing the idea of Roths right now. It's the Secure 2.0 and what it did to inherited IRAs. So if your spouse inherits your IRA, it's just like yours. So if you were taking RMDs, you've got your lifetime to do it. But under the new Secure 2.0, if you inherit an IRA that was non-spousal, you have 10 years to pull that money out. And they've gone back and forth on the methodologies and the ways to do it. They have added back in now an RMD on it, but the RMD is not enough to train the IRA by the end of the 10 years. But at the end of the 10 years, that IRA has to be zero, whether it's a Roth or whether it's a traditional. So the example I give a lot of people is I inherited my dad's IRA in 2019, and this law had not gone into effect. So I have my whole lifetime to take that out in small chunks over my lifetime. If he had passed in 2020, just 1 year later, I would have 10 years to take the entirety of that IRA and take it as taxable income to myself, which, just based upon age and timing, that would have been in a very bad, income generated. Hopefully that's in my peak earning years. But it can really exacerbate problems, and you don't want to do that for your heirs. So we're protecting our heirs from future tax burdens by doing that. If I had inherited a Roth, I still have to take it out in 10 years, but I have no taxes when that money comes out. So the Secure 2.0 made it even more important to do things like this. So this is kind of a busy table that I use for showing off a Roth conversion. So in this scenario, somebody who's 65, they have $50,000 in their IRA. Let's say you grew at 6%, you'd grow $3,000 a year, you'd end your balance in your IRA at 53. And I took this chart all the way down through 100. So if we're growing at 6% a year, which I realize is not like we never grow in a straight line. Just we don't. But on average, if we're doing 6% a year, in the year that we turn 73, we start having required minimum distributions. So there's a factor out here on how that works. So we basically just divide the previous year's ending balance by the factor, which gives us how much has to come out. And then if we're in we'll call this the 20% tax bracket, 2,000. Nobody wants to be in the 2,000 bracket. 20% tax bracket, you can kind of see the tax ramifications of that. So that $50,000, if you earn 6% for the rest of the time, you can kind of see how the balances start going up. And then as you get closer and closer to 100, the balance start going down because the distributions for the required minimum distribution are higher than our growth. So then the question is, well, what if we had done a Roth conversion when we were 65? So let's say we retired at 64, we don't have our W-2 income, and we do a Roth conversion. So let's take $10,000 out of the IRA. We're going to do it right at the end of the year. So here we owe $2,000 up front. And then you move to the second column. This is what's going on in the Roth IRA. So we've got our $8,000 in here. Now, the Roth, I've got scheduled to grow at 6% as well. So because of that, these numbers get smaller in the required minimum distribution, significantly smaller over time. And then the taxes on them are smaller. So at 100, and I realize that's a long out example, but even if we were to look at, let's call it 86, you would have $71,000 in your traditional, and you'd also have $27,000 in your Roth. That's just doing that $10,000 conversion. Compared to if we were looking at 86, if we don't do the conversion, we're higher here, but not in total. So we've only got 87 here. So when we take the 29 plus the 87, the value of not having to take these required minimum distributions on that portion makes a big difference. And so when we look at it in the 20% tax bracket, let's say we did $10,000 a year for 3 years in a row. And each year we're paying 20% tax and we're moving it over. Well, now it's dramatically different. So this account's worth 41 at 86, and this one's worth 77. So combined, we're looking at a much higher factor. We're at 118 as compared to where we were at before. And that's the amount that your heirs will ultimately inherit. And kind of like if you wanted to be really silly about it and take it all the way out to 100, the value difference would be combined. They would be at 193 when you're 100, as opposed to if you never did it, $41,000. So that's $150,000 shift during this. Now, granted, that's a very long time period. And there's other things that can go into it. So that's if we're paying the taxes out of the IRA contribution. So we take $10,000 out of our Roth, we pay $2,000 to the government, we take 10 from the traditional, pay $2,000 and put $8,000 in the Roth. If we do that just on one, kind of to give you an example, and this is that break even, that 8,000 will grow somewhere in between here. So if we did it at 65 at the end of the year, you'd have your entire 66, 67, 68. So it's about 3.5 years to break even on that at 6% growth. And that's having the same growth in both. If instead of paying the taxes there, and we move the entire 10,000 because we can pay the 2,000 out of our checking account, we accelerate that faster. So, we're at 12,000 here. So in that same time period, we're positive versus not doing it by about $600. And so that's where the break even makes sense. Now, where it doesn't make sense to do a Roth a lot of times is if we're not going to grow it. So if we're going to sit it in like a 3% CD, it can take a significant amount of time. Brought that through. To make that break even point better, because we're not growing fast enough. So we do want to have some risk, some growth in there. So what we would traditionally look at doing is saying, all right, well, let's say your traditional IRA was a 50-50 account. So 50% stocks, 50% bonds. We're going to make the traditional IRA much more conservative, and we're going to move that growth potential over to, so you might have a 100% stocks in the Roth, but significantly higher percentage. And then in the aggregate of them two together, you would maintain your allocation. So there's things to consider when you look at that. And so these are kind of some of the strategies that we look at and say, especially in those years where post working life, before we get into a huge amount of other income, if you're in the 10% bracket, can we do that same type of conversion where we only have to put $1,000 in taxes? The numbers get even better. And we pair this with looking at charitable contributions. So let's say we wanted to be able to give $1,000 a year, or let's say we want to be able to give $3,000 a year in charitable contributions once I turn 73. What we could look at doing is saying, okay, well, if we convert 20 in Roth in years 65 and 66, during this time period, we can use the rules on charitable contributions where instead of those being distributed and taxed at 10%, they're tax-free because we're sending them straight to a charity and we're using an RMD to do that. So that's kind of the thought process behind a Roth conversion. And there's a bunch of logistics, and Chastity is the one to know all the paperworks and ins and outs, but it really is a powerful tool in looking at it. And everybody's situation is a little bit different. And we run the numbers based upon where you're at in your life. So you can easily, actually, one of the things I've done for a couple of people is if we look at, not 10,000, we need to, $10,000 a year. So let's say you basically zero it out. If we're able to do it at the 10% bracket, your total tax bill here is $1,000 a year. So that's $6,000. The rest of your taxes out of the IRA are almost nothing. So your total tax bill, if you lived to 100, would be $6,276. As opposed to, if you never did it, $16,157. So there's a huge tax savings when we do things like this. And so we look at this a lot, and I think it's going to get more and more important. We'll see where tax brackets go. We'll see what they're able to actually get through Congress as far as the 2017 tax cuts expiring. The House will, like I said, do what they do, and the Senate will do what they do. But it's a real narrow margin, and so we're trying to plan on taxes being higher in the future. And even if they're not, let's say they extend this strategy, I still think makes a lot of sense. And we'll just run everybody's situation based on need. But I'll pause there because that's a lot to take in. But that's the concept, and I think it's one that we need to be utilizing as much as we can.
Peter, how does that affect someone who's on a retirement income and in their late 80s?
Right. So if
and
we
doesn't have it, and I don't have a Roth or an IRA, either one.
Right.
Is it possible to?
It's still possible. There's a couple things to look at doing. So you don't have to have income to do this because it's already in the IRA.
I don't have an IRA.
Right. And so without an IRA, what we can look at doing actually is what they would call a backdoor Roth. And that's a kind of a different concept in that you make a non-deductible contribution to an IRA. So we would open a new IRA. You make a non-deductible contribution to it, and there's some eligibility things, and we go through that whole rigmarole. And then from there, you're looking at doing the conversion, and there's without having other IRAs to deal with, it makes it a lot easier. If you have an IRA already, doing a backdoor Roth can be kind of messy just because of tax rules on it. 401ks count different than traditional IRAs and all this, that, and the other. But there is a way to do it with a backdoor. We would just go through all the eligibility items. The question though then is what are we getting there, in that situation? You do get the tax-free growth, which is nice. But you're not getting the inheritance benefit in the same way, in that if someone inherited the money just from a regular investment account, they're never being forced to pull it out to themselves in taxes. So we don't get that benefit in the same way. So there's just a couple of, wrinkles in that, but there are ways to look at it and say, does it make sense for me? Am I going to get enough of an economic benefit to make it worthwhile? And we just run the numbers.
Well, we may need to explore that sometime. I'm going to have to leave, so thank you so much.
No, absolutely. Thank you for coming and participating. And we'll see you down the road.
Okay, thank you.
Got one that was emailed into me because they knew I was going to be talking about this. And it was in regards to IRMAA. So this is a big one. So once we hit Medicare age and we're having Social Security and we're drawing off of that, we're using that to pay Medicare. Your bracket is dependent upon your income. And so for a individual tax return based upon your 2023 income, and then the 2025 brackets are based upon your 2023 income. The 26 will be based on your 24. So we have to be cognizant of this going forward. They look at the modified adjusted gross income in a tax year. And so if you're under $106,000, your premium is $185 for Part B, and there's no surcharge for Part D for the people who use Part D. But all of a sudden, if you jump into the 106 bracket to 133, your monthly premium jumps from 185 to 59. And so over the course of, and then you've got also additional premiums to go on your Part D. So we're looking at roughly an additional $888 for your income or to pay for your Medicare over the course of the year. If we jump to, and that's if we went to 106,001, it's not graduated. If we jumped up into this next bracket, the 133 to 167, you're looking at an additional, it doubles your cost. And so you're at $2,220 additional cost during the year. So that's where we want to be really aware of how much your other income and how much in modified adjusted gross income you have. Because let's say you have, you're at $80,000 and we did a $40,000 Roth conversion. Well, all of a sudden we're up in here. If we're at 105 already because we have a capital gain or we have a large amount of dividends and interest in a given year, and then we add, a 30,000, we could be up in here. And the math still works out that it is tax and net positive if you have the right level of growth. But it doesn't make it hurt any worse, or any less rather, when your monthly premium goes up. And then there's this whole process of how long it lasts until it comes back down. You have to prove that your numbers are back down, or it takes like 2 years of tax returns for them to get it back down. So it's a real hassle. So that IRMA is a big thing to be aware of when we're adding income. And so that's another reason why when we go back and look at the slides of that early period of time before retirement, so before we're taking Medicare, that could be a really good time period to do it. So especially for people who retire early or they start to fade down their income as they go into retirement, that can be a place where the Roth conversion sits. Anybody else? I think, I've got a couple of people who had sent me texts on things, but I think we've covered all those. I'm going to stop here, and then we're going to do this once a month, hopefully, give or take 30 minutes, 45 minutes, hit a topic of interest. So please send in things that you'd like us to hit. And then, the idea being I'll do a quick little market recap, do a topic, and then open it up to anything. So it doesn't have to be, on a particular covered subject.